Beta is used to measure the variability between a specific stock's rate of return and the market as a whole. If a stock has a beta of +1, it moves with the market. When a stock has a beta of -1, it moves the opposite of the market. A beta of more than 0 but less than 1 is a defensive issue that is not as volatile as the market. Beta measures a stock or a portfolio relative to the S&P 500, the market as a whole. Financial ratios are used by fundamental analysts for comparison purposes. The current ratio formula is current assets divided by current liabilities. It is a measurement of liquidity. The quick ratio is also called the acid test ratio. It is the most stringent measurement of liquidity. The formula is current assets minus inventory divided by current liabilities. The debt to equity ratio is a measurement of leverage. The formula is debt divided by debt plus equity. The formula for working capital is current assets minus current liabilities. It measures how likely could a company withstand a short-term economic downturn. The formula for earnings per share is earnings available to common divided by number of shares of common stock outstanding. Valuation ratios are used to compare companies in the same industries. The formula for the price-earnings ratio is current market price divided by earnings per share. Growth stocks have high price-earnings ratios since they have low to no earnings. Value stocks have low price-to-book ratios. Blue chips have higher dividend payout ratios than growth companies. The formula for current yield on a stock is annual dividends divided by current market price. The formula for current yield on a bond is annual interest divided by current market price. The risk-free return is the rate of return on the 13-week Treasury bill. Standard deviation measures the dispersion around an average. It is the mean of the means. The lower the standard deviation, the more likely the past returns will repeat themselves in the future. The Sharpe ratio measures risk-adjusted return. Its formula is actual return minus risk-free return divided by standard deviation. If two stocks have a perfect positive correlation of +1, then their returns will be the exact same. If two stocks have a perfect negative correlation of -1, then their returns will be the exact opposite. Mean means average. Median is the middle number. Mode is the number that appears most frequently. Range is the difference between the highest and the lowest number. $1 today is worth more than $1 in the future due to the time value of money. When the net present value of an investment is 0, the discount rate being used is the investment's internal rate of return. If the investment's internal rate of return exceeds the client's hurdle rate, then it is a worthwhile investment. The internal rate of return on a bond is its yield to maturity. If the net present value of an investment is positive, then it is an acceptable investment. When the net present value of an investment is negative, then it is not a worthwhile investment. The highest net present value occurs when the discount rate being used is 0. The higher the discount rate, the lower the NPV. The rule of 72 can tell you how long it will take an investment balance to double when the rate of return is known. 72 divided by the rate of return will tell you the number of years it will take for the money to double. Using the rule of 72, you can determine how much an investment must earn in order for the money to double in a given period of time. 72 divided by the number of years invested equals the rate of return needed for the money to double.